Well, good morning, early birds and investors across the nation. This is Mark Robertson. I am founder and managing partner of Manifest Investing, and welcome to one of our Saturday morning A Few Moments With sessions, also known as Open Keyboard, Open Microphone, to encourage all of you to enter your questions or suggestions or things that you want to kick around in greater detail. We'll keep it that way. As we generally do on these Saturday morning sessions, things will be pretty informal. If you have something you want to cover in greater detail, please let me know. I will be monitoring for questions and answers. Either you can raise your hand if you want to speak across the microphone, or you can enter a comment or a question using the questions tab. And again, just welcome, especially if you're joining us for the first time. Perhaps you're a government employee that heard about this and is just checking in to see what this might be about. And what we're going to cover here today is really pretty simple. Any retirement plan, any qualified plan, it's important to know what you own and why you own it. And that comes down to understanding what's on the menu and how to deal with the various components, the items on the menu. And the thrift savings plan is kind of unique in that it's a fairly robust and powerful system, but it has a fairly limited number of choices, which actually makes it easier for us to demonstrate. And fewer choices is not necessarily bad. Academic studies have proven that companies that offer their employees, especially those that are not hobbyist investors like many of you in the crowd, when you are faced with literally hundreds if not thousands of options, sometimes people can get kind of log jammed up, and it can be a real problem. Sometimes fewer is better. We think simpler is always better at Manifest Investing, so We'll try to stick along those lines. These things are serious stuff. I mean, all of the qualified plan features of 401ks and that kind of stuff are represented. Again, the only distinction that I can draw is that there's fewer choices. So we're going to take a look at those. That is my email address at the bottom. Copies of this presentation will be posted to the Manifest Investing forum, or you can write to my email address, markr@manifestinvesting.com, if you'd like a copy of the slides. We will record this and make it available also in the forum or on demand. And those of you that are in the Twitterverse, you can find stuff from us at Manifest Invest, that little birdie there on the right. So let's go ahead and get underway. Again, welcome to the session. Many of you already know this. No investment recommendation is intended. We're going to talk about the real alternatives and the options that are on the menu for the thrift savings plan for government employees and retirees. And everything we do here is a demonstration. It's an illustration of putting the philosophies and principles of the modern investment club movement to work as individual investors in this case. Special disclaimer down at the bottom there, I am not a government employee, a certified financial planner, an attorney, or an accountant. Don't play one on TV either. What I am is an investor and a person who tries to help people understand the realm of investing, and in this case the realm of a qualified plan and the opportunities that are available to them through, in this case, their employer, the federal government. Here's an interesting slide. We're going to talk about Twitter a little bit later today, but this Twitter slide came across on my feed. I don't remember. It was probably yesterday or the day before, and it's from TIAA-CREF, who is the provider to many of the teacher or educator retirement plans nationwide. They've got a whole bunch of good stuff. And again, they're just sharing the point that in general, Americans are not familiar enough with the opportunities in their retirement plans. Don't understand them well enough. It's aggravated a little bit by gender and certainly by age. And I don't know about you guys, but back when I was between 18 and 35, probably a whole lot less focused on retirement than I might have been, and I don't think that that's terribly unusual, that a younger person would be less tuned in to retirement plan topics and issues. So here's what we'll talk about here today. We're going to demonstrate implementation of a thrift savings plan dashboard at Manifest Investing, but characterizing the opportunity, selecting the characters, the investments that are out there in the world of investing that best match the federal plan options. And again, the specific components of the TSP are not publicly traded investments. So they actually don't have ticker symbols, and so you have to find something out there that will behave very similarly to the investments that are on your actual statement. We're actually go through and build a TSP dashboard. Pretty quick and simple. We'll go with questions and answers, and again close with what's on your mind. Anything else that you'd like to cover. So let's start with this little look. A lot of times people use 40-year, 50-year periods for this sort of thing. That kind of makes me dizzy. Let's stick to 20. So for the last 20 years, the annualized, those are not average returns, those are annualized total returns for the last 20 years for the TSP funds. And I've listed the 5 main funds. There are another 5 life cycle funds, but we'll talk about those later. The 5 primary options, G, F, C as in Charlie, S as in small, and I as in international. And you can see that over the last 20 years, on an annualized basis, the highest return is from S, which is the small company and medium company option. It's basically a mutual fund that emulates the performance of a certain group of stocks. C is the S&P 500, but again, sometimes this stuff is presented and somebody will look at this and say, well, heck, if it's been 20 years and that's been the return on S has been 10% and the return on basically what our money market rates down here have been like 4 or 5%, I'm just going to throw all my money in S and be done with it. Why not just put it all in S and let it ride, especially if you're a fairly young person? There's more to this than that. Here's a look at the actual definition of what the 5 options are, starting with the G fund. The G fund is basically, the way I'm going to describe it here this morning, it's like a money market account on steroids. They're government securities. They have an outstanding performance record over the years, and whenever you're in doubt and you have access to one of these funds and you don't know where to put your money, having it in the G fund, there's nothing wrong with that. It's actually outperformed a number of things, and we'll take a closer look at that. A little bit more robust and basically operating at about a 1% advantage to the G fund over time is the F fund, and that's just basically loaning money to people. Specifically the government in most cases, but some mortgage-backed stuff comes in here, so it's just a little bit friskier and a little bit higher returns, and we'll take a look at how much more bumpy it is. C is kind of the core fund. It is the S&P 500, as you see down here at the bottom, basically emulating or trying to track or match the performance of the S&P 500. So it's the 500. Now they say medium-sized companies here. You can cross that out. These companies are all big. They're all large. There are very few small companies in the S&P 500. In fact, they're all what many people would consider mega large. And so this is a large company fund of 500 companies, the top 500 companies, and they're basically U.S. That's a domestic large company fund. Okay, the S fund gets a little bit more interesting here. Theoretically, it's small, but it does include a bunch of medium size. It does not include the companies that are in the S&P 500, so it doesn't include these. And it actually tracks the performance of what is known as the Dow Jones U.S. Completion Index, and all that is an extended market. The way that it is characterized out in the public arena is as an extended index fund, basically taking the Wilshire 5000, subtracting out the S&P 500, so you're left with about 4,500 companies. The companies that actually try to match the performance of this completion index actually end up investing in approximately 3,000 or about 3,200 of these companies that are X or outside the S&P 500. So that's what you're looking at, and these can get actually quite entertaining and very, very frisky. I stands for international, and these are international stocks. There's a lot of stuff going on, a lot of stuff in the media, a lot of new stuff these days that's talking about emerging markets. These are not emerging markets. They're developed. When you see the list of companies, you're going to see that they're all pretty well established, mostly large companies, and certainly in developed countries. So all of the fervor and fever that you hear about potentially investing in emerging market companies, that's really not represented by the I fund. completely different concept. And in fact, I think if the government could do a couple of things, one of the things that they might want to consider would be some type of an emerging market fund to add to this roster. But I can't, that's way above my pay grade, so let's just move on. Okay, let's go ahead and talk about the 5 options that are there. Again, this is the G fund, and what we want to take a look at, again, when you're dealing with manifest investing and keeping it simple, we talk about 2 major features for every single investment, whether it's a stock or a fund, and that is the return forecast, the amount that you can expect to get over the long term from an investment, and the quality of the investment. Now, G fund is going to have a very high quality rating because it's, again, guaranteed government obligations, very low risk of a default situation on these. And these are the annualized returns going back 20 years. So that's what you're looking at here, a 20-year profile of the G fund. So again, when you saw on that previous slide that it's averaged somewhere around 5, in fact it's 4.7 going back 20 years, 4.7%, that doesn't tell the whole story as you've seen here. Interest rates have been low here the last few years, and as you can see, the last few years we've been dealing with 1 to 2%, basically historical lows for the G fund going back for the last couple of years, and we do expect that to persist for a little bit while longer. I do think that this will probably bottom out and these will head up at some point in the future, but probably not anytime real soon. So when you're investing in the G fund, for the foreseeable future, you're talking about relatively low returns. What we did find when we went back and looked at it, it does tend to track the 5-year yield. And that's what we actually use to characterize it, the 5-year yield plus an increment, kind of an error component, but an increment, and that's why we would expect to see somewhere in that 2% neighborhood going forward. The real benefit of the G fund, well, it's never had a losing year, and over time, $100 invested 20 years ago would now be worth $250, and again, it's just a real steady, no downward glitches in it, and it's basically a nice place to hide money if you think things are really turbulent or while you're deciding what to do with it. In fact, many of the deposits in many of the accounts, and again, I mentioned before, I'm not a government employee. I don't actually operate on one of these accounts, but I have noticed and heard from people that the money, if you don't tell them where to put it, it defaults into the G fund in many cases. Let's take a look at the second option. It's the F fund. And again, not exactly investing with the banks, but investing kind of like the banks, where they just have an assortment of fixed income securities and bonds, and it's just going to be a little bit more frisky. Way to remember that, the F. So it's kind of G, but only a little bit more frisky. And you can see that over the years, kind of bounces around a little bit more than the G, and you notice that it actually has had 3 years, including last year, when it outperformed, when the returns were actually negative last year. So again, it operates at a slightly higher level. You see this 5.8% annualized, but that plus or minus for any given year is a little bit more. So you get a % or 2 more return per year, but the price you pay is that every once in a while you're going to get hit over the head with a little bit of a 2x4. So again, over the longer term, unlike the G fund, there are a couple spots in here that are fairly flat or even down. So that's the difference between the two. Again, a little bit more return, but the risk of running into a speed bump along the way. Let's press on and talk about what I would consider to be the core, especially for a younger person with the right risk tolerance in investing. This is the C fund. Probably a good 40 to 50% of the accounts in the government retirement plan are in this fund. It is the S&P 500. And again, here are the returns over the years. And again, much like the F fund, there are only 3 or 4 times when we had negative returns, but they're bigger. Bigger negative returns, including the really nasty ones back during the Great Recession in 2008, 2009. So pretty tremendous volatility compared to that G fund. We had these 2 moments of quite a significant downdraft in the market, but notice the recovery. And in fact, there's a couple really nice insights article on the tsp.gov site that talk about how quickly this actually did come back and get back to where it was pre-Great Recession. So again, over the longer term, something in the higher single digits for would be a reasonable expectation, somewhere up in here. And I think we can see that the last couple of years have been fairly special. 2013 featured a return in the low 30s. Again, third best return in a given year, going all the way back to the mid 1990s, and kind of these glory years for investing back in this time frame. So we kind of experienced one of those years. Hopefully, if you were a government employee that was seeking to hide after this nasty stuff that went on in 2008, 2009, you were back well in advance and investing regularly and taking advantage of that uptick. So again, know what you own, know why you own it. The S&P 500, if you take a look at either Morningstar or, in this case, Manifest Investing, specifically, what are you buying? You're buying these type of companies. These are the top 10 by the size of the investment in the S&P 500. It is cap weighted. So basically, Apple has the largest influence on the S&P 500. Second would be ExxonMobil. But again, these are giants. Going right down, a lot of financial stocks, Wells Fargo, JP Morgan Chase, Berkshire Hathaway. You know, some of those financials are a big part of the reason for that hit back during the Great Recession. So again, we take a look at them. We're going to cover how we look at them here in a few minutes. But again, this focus on the return forecast, the projected annual return, or the quality rating. And we want to see good and excellent companies when we actually select them. And in this case, by selecting the S&P 500, you're getting a really robust group of fairly high-quality companies, at least at the top end. And that's what you'd be investing in. Let's go ahead and talk about the S Fund. It stands for small and medium stocks. And again, same situation, only now the roller coaster is even bumpier. You have now 5 times, including a fairly recent incident back in, that would be 2011, where the S Fund went negative for a year. It's certainly not immune to the problems back in the early 2000s, certainly not immune to the Great Recession. And took a pretty good hit in all those cases, and then another one back here. So again, more often negative, in general higher, but again, the bumpiness, again, think roller coaster, the plus or minus for any given year is a much broader band. So that's what you're buying into. Over the long term, you can see the roller coaster there on the right, definitely a bumpier ride, left to right. 10.2% is the annualized amount for the companies in this extended market or completion index type fund. The names are going to be quite different. In fact, these will fluctuate pretty significantly over time, but these are not the companies that were on that last slide. There's some fairly new companies in here, some really hot companies like Las Vegas Sands. I think Illumina was up 40% last month. These are the top 10 by the size of the positions, again, within this extended index. So again, the ones that get red hot, Green Mountain Coffee had a really good month. The ones that get red hot are going to actually end up at the top of this list. And again, many times when a company gets overheated, their stock price soars, the return forecast actually can go negative. Keep in mind that there's another basically 3,000 companies off this page. So you have to keep in mind that these are going to be, the ones that are shown at the top of one of our dashboards are probably going to be among the hotter, highest surge in stock price components of that index. Keep in mind that they are just a piece. Last but not least, here is the iFund International Stocks component. Kind of the same situation, going to be kind of a similar volatility to what we saw with the S Fund. 5 incidences of negative returns. What is kind of interesting about this one, and again, this kind of goes back to 20, 25 years ago, back when the theory was that when the domestic stocks or the United States companies zigged, the rest of the world basically zagged, and that actually went back for 30, 40 years. It was referred to as kind of an efficient frontier. The theory in the certified financial planner world was that you had to have some domestic stocks, and then you would offset that with international stocks so that they would kind of cancel each other out or balance each other out. When the U.S. was down, the rest of the world was up. Well, that hasn't been true for such a long time, at least these 20 years. basically the international stocks, and including the emerging stuff, even though it's magnified there, they basically do track the U.S. It's one big planet, one flat world, if you want to think of it in Friedman style. And again, the international stocks that are offered through the TSP are the more established, consistent, less bumpy, not the same thing as emerging. Take a look at these names and you'll see what I mean. I mean, some of these are absolutely household names, either painkillers or automobiles or gasoline. Very, very established, very large companies. So again, not a lot of growth there, and that's got something to do with this relatively smaller return over time. Not bad investments from time to time. Sometimes they get really, really attractive, but again, not that efficient frontier thing went away a long time ago. And one of the ways I know this is I went looking for all the slides that the CFPs used to use showing that picture. You can't even find them on the internet anymore. Somehow they managed to blow most of them away. With that, I'll pause for see if anybody has any questions on the 5 alternatives before we press on a little bit. Not showing any questions or hands up. Let me double check to make sure that nobody does have their hand up. And again, I just want to repeat, I'm seeing a number of new names that have not been at these sessions before, so welcome. Hope that you're enjoying it, and let us know if there's anything that you're curious about. Not seeing any questions, so let's go ahead and press on. Okay, so at Manifest Investing, as I mentioned a few minutes ago, these are not publicly traded funds. You know, GF, CS, and I are not publicly traded. They don't have a ticker symbol. There are places where you can keep track of it. We'll talk about that later. You can keep track of them on a daily basis, and certainly with your online accounts and your monthly or quarterly statements in the plan, which, by the way, is all we think you need. But don't need to be looking at this stuff every day, and shouldn't be probably in most cases. But here's basically the 5 things that we think are the best match. And we took a look at, you know, return and a number of characteristics to see that we were talking about the same set of stuff, basically. So for the money market on steroids, the G fund, basically we use this fund, which is a ticker symbol VSGBX. That's a Vanguard short-term federal obligation fund. And again, its track record is pretty good over time. We treat that as a non-core, almost a cash equivalent type investment, so it'll look a little bit different on our dashboards. But again, probably looking for about a 2%-ish type total return for this year. Second fund, F, is best matched by a Vanguard Total Bond Fund, VBMFX. And again, just a little bit more friskiness or gusto of returns, a little bit more volatility or price moving around, returns moving around. Blue chips or core, this is an easy one. You can pick whatever you want, either the Vanguard version of the S&P 500 mutual fund, or you can use the ETF SPY. That's a SPDR. It's an exchange-traded fund. One of the reasons I think it's probably the better one of the two to choose is that the management fees and administrative expenses at the TSP are actually very exchange-traded fund-like. The expense ratio on the stuff is definitely lower than most people have access to, and SPY would be consistent with that also. Lower expense ratio with SPY. On the small and medium stuff, that extended market thing, we are looking at the VEXMX, the extended market fund from Vanguard. Again, that's an index fund, and the performance and characteristics of that match up pretty well with the S fund over the years. I should mention that these funds are basically administered and run by, for the most part, BlackRock, the giant asset management company, and could actually find some tracking investments that are in their family of funds, but these will actually do the job for us and keep it pretty simple. International. Again, these are those large international established kind of stalwarts nationwide, or excuse me, worldwide, and we can use the exchange traded fund EFA to take care of that. Now, we're not going to talk about lifetime funds. We'll probably spend just a moment with them here at the close, but all the lifetime funds are all of these things, all of these 5 with different allocations based on basically a retirement date. And we'll take a look at that. So it's just different blends depending on where you're at in your life cycle and risk tolerance of these 5 funds. Let's spend just a moment talking about a couple of things. Just again, some of the people are relatively new to Manifest Investing. Again, at Manifest Investing, as I mentioned, we basically take a look at the very long-term perspective for any company. In this case, McDonald's. We basically build a picture, a vision of where the company has been, where it seems to be going at any point in time by taking a look at very long-term trends. This top line that you see here is sales, the bottom line is earnings, and we basically subject them all to this form of analysis which kicks out a return forecast. So we have this return forecast on a company-by-company basis in combination with a quality assessment or a quality ranking for all the companies that we follow. And the components of the quality rating are shown right here. The financial strength of the company, basically the robustness of the balance sheet, the consistency of profits at the company, earnings stability, and relative growth and relative profitability versus competitors or peers to any company. So those 4 components basically add up to a quality rating, which we convert to a ranking. And we basically spend our time doing most of our time, those of us that are investing in individual stocks, out there seeking the highest quality companies, excellent and good companies that have a suitably high return forecast. One of the things I find fascinating, and again, this all will demonstrate, how we come up with the characterizations of the funds, which we'll take a look at in a second. But if you go back to that same time frame 20 years ago, February 28th, 1994, and you take a look at 4 fairly consistent household names, I didn't just pick those out of the blue. I picked them because they either led, they were either the most favored company by the investment club publication Better Investing, or at the top of our Manifest 40 most widely followed companies for subscribers. And again, so these aren't just picked out of the blue. These are 4 companies that if you had taken and invested $250,000, $25,000 into all 4 of them, basically starting with $100,000 back in that time frame. And again, I didn't cherry pick these. I just picked them based on that what I said. $100,000 invested in those 4 companies evenly is now worth almost $1.7 million 20 years later. So again, just shows you the power of picking, making good selections based on quality and return forecast. That's what we do. Here are the actual returns year in and year out. They average 15% across the board for these companies. You can see that all 4 of them have outperformed the market by a fair number of percentage points. So the market's basically gone up 9% per year over the last 20 years. Some of these have outperformed them significantly. And one of the other reasons I like to point this out is if you're doing this with any investment, you're basically knocking it out of the park, 2 or 3%. But notice if you can grab a couple more percentage points, look at the differences over here. Again, these are fantastic results. 227,000, 264,000, but just adding a couple of percentage points over the long term gets you these type of numbers. 626,000, 559,000. Those are just phenomenal numbers. And again, one of the reasons I point this out, for any of you that are either a young person or know a young person with the access to a retirement or qualified plan like the TSP, encourage the young people to get involved. I like to tell the story that a company like Stryker, Biomet, several years ago, the Biomet investor relations person was at one of our national investing conferences. My mom and dad were actually attending, and they actually sat down and had breakfast with the Biomet attendee, the investor relations person. The Biomet person told them, $2,000 invested in Biomet back in the early 1980s was worth $1 million by the end of the 1990s. And I heard that. I was really skeptical. I'm a numbers guy. I went home and I proved that the investor relations person was wrong. It was only $984,000. And you know, the interesting thing is my mom and dad are sitting there saying, wow, you know, that $2,000 put into an IRA back in 1983, you know, that could have just as easily been invested in Biomet. And this is not science fiction. This happens to, in fact, many of you in the room have experienced this. So again, just to show the power of tracking those two main characteristics. Well, here's how it works with funds. Those of you that are familiar with Manifest Investing will recognize this is dashboard type stuff, but we basically try to characterize the funds that we follow at Manifest Investing. And let's talk a little bit about the S&P 500. And again, we're focusing in on today on the quality of the companies in the fund and what they add up to down here at the bottom, and the return forecast. So for the S&P 500 today, we're basically looking at an 8% return and an excellent quality rating for the company. So what is it? It's a sum of the parts analysis. All of the pieces of this jigsaw puzzle, the Apple has the biggest piece of the 500 pieces. It's the most influential in the whole thing. Philip Morris International is 20th, so as you go down this list, they become less influential. But again, there's 480 companies that are off this page. That we basically we don't do all 400, but we do the top 100 or 200 companies until we're fairly sure that we've characterized the fund. For some funds, we actually model them. For the diamonds, where the Dow 30, all 30 companies are in there, so we're actually modeling that top to bottom, including all 30 companies. But just as you heard me say, for that extended market fund, they don't do all 4,500 companies. They stop at 3,200. There's a reason for that. You can actually model the performance or characterize or emulate the performance of the fund without having them all. Our emphasis is on the return forecast, this projected annual return you'll hear us refer to as one of the two main characteristics of any company or any fund. We do have this focus on quality. Quality keeps you out of trouble in corrections, recessions, and bear markets. This is important here. We're not showing it on this slide, but we also pay attention to the amount of growth component in the portfolio. And this kind of comes back to who you are. Anytime we're talking about retirement plans, qualified plans for individuals, it's extremely important to think about who are you in terms of time horizon, risk tolerance, all that kind of stuff. And we basically counsel that any do-it-yourself fund that you build for personal investing should have this sufficient growth component, and the same is true of the funds that you'll see in the TSP. The main difference between us and everybody else is we do a very heavy emphasis or a focus on trends. We pay more attention to the road ahead or the windshield than the rearview mirror. That's part of the challenges faced by the Morningstar rating system. Nothing against Morningstar. They're some of my favorite people in the world. But you can go ahead and go to their site and read some of the limitations that they have, because their star ratings are basically based on historical or actual results. And sometimes that's not enough. You got to look forward. That's what we do differently than many of the different things that are out there on the internet or investment research that's available. Again, we don't ignore the rearview mirror. We basically try to place the appropriate amount of attention on it while at the same time looking forward. One of the interesting things that we've noted over the years is that our efforts to pick stocks generally end up in a 50 to 60% performance accuracy. That's the number of picks that outperform the market after we basically decide that we think they're going to. And in the case of mutual funds or just funds in general, we have this thing in our monthly newsletter called Hoard versus Herd. And in this case, the Hoard, it's a retirement plan demonstration. The funds that we pick for this demonstration actually have a higher accuracy. They behave better than some of our stock picking efforts. That number, by the way, is down. It's actually been up closer to 80% not that long ago. So again, this stuff can be rather compelling. So let's go ahead and talk about, putting Manifest Investing to work, building a TSP dashboard, again, designing and maintaining your qualified plan account. So in this case, what we're going to do, I actually borrowed a statement from a friend who works for the government, and these were her balances in these 5 funds from top to bottom. And we'll basically go ahead and demonstrate how you would create a dashboard at Manifest Investing. I'm going to go ahead and jump out of the PowerPoint here, I think. Jump over to Manifest Investing. There was our reminder for today's program. And go into dashboards. So into my dashboards, we're going to go ahead and create a brand new dashboard. And we'll call it TSP Demonstration. Let's call it Spring in honor of the better weather outside. What I'd like to demonstrate is, again, as we talked about just a few minutes ago, these are not publicly traded investments with ticker symbols. So we have to kind of do a workaround. One of the easiest ways to do a workaround at Manifest is to use these investments that we have characterized and enter them this way. So we're going to start with her component in the G fund. I'm going to put $20,300, see the dollar sign number here, and put it into VSGBX. And then hit submit. And you'll see that we begin building the dashboard. Again, this price is not going to match the price that's available out on the internet, so we are doing a workaround here. Keep in mind that this G component is going to emulate or track the same thing as the G fund. And so the shares are calculated for you, and we now have $20,300 into the G fund. Continuing that process, we hit edit, come down here to the bottom, and we're going to put $7,150 into the F fund, which is VBMFX. Hit submit, and now you see that's been added to our dashboard. Following that same process, clicking on edit, tabbing down, now we'll put $18,050 into the C fund, which emulates or tracks the S&P 500. So you can see that we took our $18,050. Again, this is the publicly traded price quote for SPY, the ETF. But you see we've actually stuck this TSPC ticker on it just to make sure that people know that this emulates the S&P 500. So again, we've got our $18,050 in SPY. Continuing the process, going after our small company stuff. Again, that was $15,000. By the way, this has been red hot for the investor involved, and the ticker is VEXMX. So again, the S fund checking in $15,860 into VEXMX becomes the S component, and we now are, you can see it's now starting to divide stuff up here. Coming back and doing our last fund of the 5, only $560 in the international component. Clicking submit. And so what we basically have at this point is the $61,920 invested in the 5 funds. You can see that the G fund, again, that's money market on steroids. Almost 1/3 of the assets are in that fund, which has a return forecast, very high quality rating, but or ranking of 80, but a relatively low return forecast. And when you basically add up the 5 pieces, again, these are weighted averages down here, you can see that the projected return is 4%. The overall quality rating is still quite good at 77. That's a good quality ranking. But the 4% return is maybe a little bit light when you see that the average return from stocks right now expected, this MyPAR stands for median projected annual return. We basically track about 2,400 companies. So the average or the median return forecast right now is approximately 5%, 5.3%. We think it's possible in a collection of mutual funds, even with the TSP, to approach a 3 percentage point advantage to that. So you basically could build a fund in most cases that would come pretty close to 8% on the return forecast here. Not possible under today's conditions with the TSP, but you can at least try to get at it or a percentage point or two above it with the decisions that you make. Any questions about that from the audience at this point? We basically demonstrated the creation of a dashboard for the TSP. Here's your summary, and again, just kind of knocking out some of the columns to keep it simple. Again, the distribution by percent of total assets, very few dollars or percent of total assets in the international fund. Pretty good chunk in S, which has again, it's been red hot, so that return forecast is down fairly low. And you can see the overall characteristics of the portfolio. Actually, the growth component's not all that bad. Okay, this lady actually has about 450 going in her contribution allocation, her settings on the TSP site. If this were my money, again, I'm a little bit older than 40. Sometimes I don't have as much disposable income as I would like, but very high risk tolerance. And again, we're talking about time horizons that are in multiple decades, hopefully, at least according to the actuaries. Again, I'm gonna be pushing to target, the C fund, the S&P 500, which is one of the higher return forecasts, higher quality ratings. Probably would like to see a little bit more in that. And believe it or not, the international stuff, even some of those companies have been beat up pretty good over in Europe and are starting to look pretty good. From this perspective, I think I'd be targeting either C or I with my contribution allocation if this were my money. Okay, let's go ahead and talk about, there's some pretty cool stuff. I think I referred to this as insights. I guess it's highlights. Highlights and insights at the tsp.gov site. I found this one pretty compelling because a lot of you are probably sitting there thinking, yeah, but can this stuff really work? I think about that stuff all the time, guys. This goes back to a very interesting time frame in the history of investing. January, February 2009. This was a pretty dark period. Many stocks had gone down 40, 50, 60% by this point in time. People were frightened. People were confused. Some people thought the world might be ending. The Mayan thing was coming. This was really a good article put out by the TSP back in that time frame that basically said, same thing what we were saying at the time, grit your teeth, pick something, and invest in it. And anybody who followed this advice or this suggestion by the TSP back in that time frame experienced the same thing that many of our community of long-term investors experienced when the stock markets actually began to return. Let's kind of put some context on this. This is a price chart going back on the S&P 500. This is that same investment as the C fund, ticker symbol SPY. And this happens to be a 20-year chart. It's from stockcharts.com. Without a subscription, you can't look at this number of years, but you can look back 3 years. But using our subscription to look back 20 years, here's basically the performance of the S&P 500 over a 20-year period. Okay, and we want to focus in on basically 3 moments in time, because this moment right here, when the stock price had really been hammered away, was when that TSP newsletter came out. Here, so we want to talk about, well, what would we have been seeing at Manifest Investing? What would our GPS or radar, or whatever you want to call it, would have been saying back in this time frame? And we also want to take a look at a couple of fairly nasty moments in history. Again, turn of the century, right after Y2K, and this downdraft in the stock market that lasted over 2 years. Pretty nasty stuff. What did this look like through the eyes of our community, and what would we have seen if Manifest Investing had existed back then. And this moment here, right at the advent of the Great Recession, which, by the way, started on Halloween 2007. You know, what were we seeing, and what type of things might we look for to help us with taking care of our investing, not just the qualified plan known as the TSP, but investing in general. There's two graphs on here that we bring to your attention. Again, I'm not going to spend a lot of time on it, other than if you want to learn more about it, you can read it in the forum at Manifest. You can go to stockcharts.com and enter any of these terms, and they'll take you to their chart school and explain what you're looking at and how you might interpret or read. Again, 70, 80, maybe 90% of the stuff we do at Manifest Investing is fundamental. And the stuff we were talking about with building a return forecast and a quality rating for any company. But sometimes it makes sense to look at these charts because you're basically looking at psychology. In this case, efficacy. Fancy word for does it work? Does our approach to fundamental and technical analysis perhaps offer solutions for investors? This first one up here, RSI, stands for Relative Strength Index. That's just simply an explanation of when things get overbought or oversold. Again, if you go and read more about it, anytime you get up here to the top where you see these green areas, companies could be thought to be overbought in general. We're in one of those right now. Overbought for some period of time. The thing that we do like to point out, though, is that overbought can stay overbought for a very long time. In this case, from 1995 through 2000, you could even make a case for a couple more. We're talking almost a decade of being overbought. So you can be overbought for a long time. This red line down the middle is kind of the dividing line and kind of something we like to take a look at right at 50. Let's jump down to 30. Anytime that your relative strength index, RSI, is less than 30 on an individual stock or a sector or a market basis, it can be deemed oversold. So you see kind of an oversold moment here back in the late part of 2008, early part of 2009. Again, think back to that letter we were just looking at. This is back at this point in time. Again, oversold. Probably want to grit your teeth and go for it. These two moments we want to take a look at, though. One of the other things we think that it makes sense to look at in combination with relative strength, again, you can stay overbought or oversold for quite an extended period of time. This ROC stands for rate of change. It's a simple price momentum indicator, and it's just looking back at how the price changes over a 12-month period. And we find it kind of compelling that these nasty moments in the stock market here and here were accompanied by basically a begin to decline in stock prices. So you might have been able to make some decisions on the total stock market based on that. Let's go back and take a look at this one here. Again, back in the mid to late 2000 or 2001, you know, what were the conditions? The stock market had run up pretty handsomely over the multiple year period. It looks like some of the air was coming out of the balloon here late in 2000 and mid to late 2000. And if you take a look at some of the companies we just mentioned that have done so well over the last 20 years, their value line low total return forecasts, and by the way, I ventured into my valley of value lines to come up with these this morning. Those four companies, I was kind of surprised Coca-Cola was at 9%, but that's because they had had a 50% drop in price right at the time of that value line report. Again, somewhere back in the period of this red arrow here. But McDonald's, Oracle, and Stryker were all down around zero. So again, the S&P 500 would have had a value line low total return forecast pretty close to zero. Certainly low single digits. And again, would have been a time probably to avoid the S&P 500. And then you really drive the nail in the coffin when you notice that at the time, and you can go back and look, at the time, the G fund was returning about 6%. So you had the option of money market on steroid at about 6% versus a currency which was greatly overvalued. The returns were basically down at zero or less than zero. And I think the choice would have been pretty simple at the time. Again, I don't think that's science fiction or hindsight or backfitting. Here's what it looks like on an individual stock basis. Again, you basically take this and stack it up to all 500 companies, and you would have had that picture. Back during this time frame, around the turn of the century, the return forecast on McDonald's went sub-zero. And you can see it suffered pretty greatly there in the early years of the 2000s. Again, coming out of that, the returns got pretty robust in that 2003 time frame. And then again, up here towards the Great Recession, the return forecast actually bounced back up. You know, can the return forecast be a useful thing? We certainly think so. I don't think the return forecast tells you anything about what can happen to a given stock in a given year, but over the longer term, you know, I don't think it's an accident that the price peaked out here, return forecasts were relatively low. Fast forward 4 years later, the stock price had come down. The opposite is true here. The stock price had literally gone to single digits. Back in this time frame, the return forecasts were out of this world, out of the stratosphere, and fast forward just 4 years to where you see these new peaks in stock prices. So again, we stacked this up across 2,400 companies in the case of the S&P 500 companies, and this is what it begins to look like. Back at the time of these two moments here, going into the Great Recession, again, late 2008, early 2009, again, starting back around the Halloween 2007, this is one that actually was quite scary from a return forecast standpoint. We saw our lowest return forecast that we'd seen in quite some time in that late 2007, early 2008. So we should have been on pins and needles. Our advice at the time, you can go back and read it, our advice at the time was stick to the deepest of the deep blue chips, and you know, in some cases, accumulate some cash and wait for shopping opportunities. And then fast forward just a few months to November 2008, March 2009, literally was a back up the truck moment for you Cramer fans. You know, we were looking at these situations, not making this up. You can go back and read it. Our back up the truck moment, something we don't talk about that way very often. This is why. The average return forecast on the average stock in the 2,400 companies that we follow was almost up to 20%. So again, a lot of pain. We were not talking about investing in stocks at the barbershop or hair salon back in that time frame. But again, this was the best buying opportunity on the basis of these statistics, these forecasts, this philosophy going back for nearly 50 years. One of the best buying opportunities, and if you had heeded that, you know, if you'd had pulled up your TSP dashboard back in this time frame, the S&P 500 had a return very much like this, a return forecast, and you should have been dumping money into the S&P 500 or the S fund back in that time frame. I want to close with one last comment about the extended market, which has been red hot. Same chart that we're looking at here. One of the criticisms of the extended market, the S fund versus the C fund, is that basically the C fund is this blue area in the background here, and for the last several years, going on many years now, they've kind of tracked each other. Okay, they've actually kind of tracked each other pretty closely, and they're really not all that differentiated. The S fund has run up quite a bit here in the last year. It had 40% return versus 30-something for the S&P 500, but they have tracked quite a bit. The one thing that we would point out, again, we're into kind of overbought territory. That can go on for quite a long time. Again, you see these things going on here. The momentum is still there. The price momentum is still there. But if you are a TSP participant with money in the S fund, you might want to notice that, you know, back in this time frame, although they're tracking together now, back in 1998, with the Asian contagion and some of the stuff that happened, that hiccup that happened back in that time frame, this was quite a sizable drop in the S fund compared to the C fund, and it actually persisted for quite a while longer. You can see that the the C fund did not get damaged quite as badly and recovered faster. And the S fund, the characteristics of the S fund are that it is vulnerable to this type of thing happening again. if I were in the TSP plan, if this were my money, I would be monitoring for a breakdown in the relative strength in combination with a breakdown in this rate of change as a possible warning situation, the type of thing that you see here and here, because you could have one of these moments. And again, financial institutions and markets themselves seem to have one of those speed bumps, or worse than speed bumps, every 5 to 7 years. So just something to keep in mind. Go ahead and wrap up with just some of the resources to remind. I mean, there's so many powerful alternatives, and it's a well-run program. You can use this PDF to get caught up on it. There's a bunch of YouTube videos that cover all the basics, a couple of interesting price quotes. There's TSP allocation if you want to do some editorial balance, reading outside the box. He's basically recommending right now 100% investment in the S fund. I don't have any problem doing that but I wouldn't do it without keeping that concept in mind. And the newsletters, and then again, TSP is actually on Twitter. For those of you that were kind of intrigued by Ellen and Twitter at the Academy Awards, and you want to give it a start, you basically control who pushes stuff to you. And in the case of TSP, let me go ahead and show you. If you were to create a Twitter account and add them to your follow list, this is basically what you'd be looking at tsp4.gov is who they are. They basically post newsworthy stuff. It's relatively new. They've only got 34 tweets, and you can see that it doesn't happen every day, but every time that something fairly newsworthy, well, there's daylight savings time coming, along with some suggestions and potential topics. So you can actually add them to your list and follow. They're on my list. I am following them, as you can see here, where it says following. So anytime they send this out, I'm actually going to see that in my feed. Now, I follow a whole bunch of entertainment and investment type topics. So here's what mine actually looks like. I'm following, as you can see, 600 different entities. So you can actually make as few or as many as you feel like. Sometimes it's fun to follow some of those entertainment folks, but one that you definitely probably want to follow is @ManifestInvest, because that will look. Just follow Manifest Investing and the TSP stuff. All right, let's go ahead and open it up for any questions or comments. Anybody wants to go back and revisit some of the dashboard stuff, we can certainly do that. Again, if you have a microphone, let's go ahead and unmute Mike Higgins. Go ahead, Mike, what's on your mind?
I just want to check, can you hear? I tried the headset to cut down the feedback. Is that working any better?
It did cut down quite a bit.
Okay, good. Yeah, as you were talking, I was trying to go through and recreate, create a dashboard that kind of duplicated, what I've got in the TSPs.
Right.
And the one thing I noted as I did that was, obviously the price of the stocks in there, or the price of, say, the C fund, the price per share, was different than the price that is in the TSP, and I understand some of that, but what it did was it distorted the amounts in the distribution that I had. Any suggestions on how to address that?
Great question. Yeah, here's what you're looking at. Let me go ahead and demonstrate one of the. I'm pretty sure these guys have quotes right here, don't they? I thought they actually had price quotes. Let's go back to the home page here. Well, one of them did. I've lost track of which one does. Well, what you're looking at, Mike, I'm getting a little bit of feedback.
Yeah, I'll mute it and unmute it from here.
Okay. Yeah, what you're looking at, and this is where it's a workaround situation. In our next design of the website, what we'll probably do, again, those prices are out there, but they're not, because there is no ticker symbol and they're not out there. It's not an easy thing, but we can probably pull those prices in for the 5 TSP options in the future. But they're still, you know, the underlying investments are still going to be these animals here. So between now and then, basically what you can do is, let's go ahead and demonstrate that one more time. What I'd like to do is we'll add a dashboard, and again we'll just call this one Higgins TSP just for kicks. And again, if you've got an investment in the C fund, so you're going to actually put the money in the C fund, and let's just say you've got 81,465 in it. You'd actually take this balance off of your TSP statement and then hit submit. Okay, and what it's going to do is it's going to put your 81,465,000, you know, into that TSPC investment, but it's basically correcting for the difference in price. I mean, the other way would be to put out a table of correction factors between the SPY price and the C TSP public
I see the error that I made. I put in the number of shares as opposed to the amount of cash. So
okay.
That's why the dollar value got thrown off. But,
yes.
Yeah, that'd be a good workaround.
Yeah.
The reason why I was concerned was that what I'm wrestling with right now is, you know, yeah, the small caps have had a run up, and I'm looking now in terms of rebalancing and trying to figure out where I'm going from there. So the dollar values that are in there were throwing me off. Okay. Thank you.
If you use the dollar values, and I think, Mike, I think you're probably not alone here. Let's say you had 200,000 in the small companies, which have had quite a run up, and they're kind of to the point where some people's portfolios could be getting overpowered by the S. And again, it's a good thing. They've had a big run up in price. And again, if it were my situation, I would probably take this portfolio and say, you know what, let's copy it to a worksheet so we can do some what-if games with it. And I'm going to add the international component to the portfolio to compare side by side. And what you're looking at here is a very quick dashboard. We call them sandboxes. The investment at the bottom right now of the pile, again, because of the huge run-up in price, is S. And if it were me, I would, you know, again, if this were my money and I was looking at this situation, I would probably shuffle some money from S to I. So what I would probably do is, let's go ahead and dump off, let's say, half of it. So I basically took and set aside some of that S, which has been red hot, and it could continue to stay hot for some time to come. But at the same time, I created $100,000 worth of cash. And again, this is one of the enhancements we'll probably make too on the redesign. I want to take that 101,390 and put it in the TSPI fund. And to do that, I might just as well put, let's go with 1,400 shares. So now what I've done is I've diverted some from the red hot S over to I and improved the overall characteristics of the portfolio. So that's the type of thing you want to do. And again, the workaround is just to get around the fact that these prices are not going to match the published prices on the TSP account statement. Now, at some point in the future, we'll probably use one of those sites to come up with where the prices will match. But for now, this will have to work. We're not the only ones out there that have to do a workaround. All right, I'm going to go ahead and mute you, Mike, and open the floor up with Ron Thorson. How you doing, Ron?
Mike, can you hear me?
I can hear you. Are you responsible?
Oh, you hear me.
Are you responsible for sending these 40-degree temperatures to us?
Yes, I am.
We'll
yes,
take it.
I am.
Keep it coming. What's on your mind, sir?
I'm wondering if you can add ETFs to a dashboard. And also, does these others, for the growth and financial stability, I see they vary a lot. Is that something that you should take into factor other than just par?
Yeah, we're trying to keep it simple here today. You know, you've been around the Manifest community long enough. We do focus in on the return forecast kind of first, a quality ranking in general, and the growth overall. We'd kind of like to see that up close to double digits. But yeah, anytime you're thinking about, you know, one investment versus another, in this case, let's go ahead and set these aside so we can compare C versus S. You know, in the case of the smaller company and the medium-sized companies, they're bumpier. They've got less earning stability. They've got weaker balance sheets, again, spread over 3,200 companies, and a little bit lower quality ratings. So you kind of want to, you know, keep that in mind also. All this is telling me is that in a correction, or, you know, something that happened like back in the Asian contagion back in 1998, these are going to, the companies in the S fund are going to get hammered quicker and harder than the companies in, again, there are no guarantees in the world of investing, but it's all probabilities. They're probably going to get hammered faster and harder than the companies in the S&P 500. You know, every time you hear the guys on TV talk about flight to quality, they're basically talking about the higher quality component of the S&P 500.
And one other question, you haven't shown the charts. Is there any information you can gather from the charts?
In the current iteration, not quite so much. We're going to go through, you can do growth, but we're going to actually in the next design phase, you can see we just categorize them as completely funds. We actually are going to add the sector component. Let me demonstrate though. If you go to, let's use EFA. That would be the I fund, and if you go to Morningstar, and you can actually drill down into the portfolio. You can do this with all 5 of the options. You know, you're not going to see much with the G, but because G really is just kind of a cash fund. But you can actually drill down into, you know, what is the distribution by sector of, and we'll obviously be taking this information and bringing it to Manifest to make it possible to check into the sector distribution for any fund. And then what is specifically in there? Let me see if I can get to holdings. Again, if you're curious about what's in any investment, and most of the stuff is free at Morningstar. Again, I'm not making this stuff up. When you're buying into the I TSP option, this is what you're investing in. And those are some pretty, although, you know, Toyota and Honda and those type of companies, we don't like to talk about them too much in Detroit. But those are good companies. Siemens, Novo Nordisk, great company. So does that help a little bit, Ron?
Yeah, thanks, Mark. Thanks.
You're welcome. Anybody else have any questions? You did ask, can a dashboard be made of ETFs? Absolutely. Even outside if we go outside the concept of the TSP, we'll go back to dashboard home. Well, let's just add another dashboard just to demonstrate that this can be done. And by the way, for those of you that are relatively new, if you want to look at a fascinating portfolio experience, it's several years old now. We call it our bare naked portfolio, and we'll take a look at it here in a second. The reason it came to mind is I wanted to, let's just put $100 in each of a few different ETFs. We use the Vanguard Growth ETF, ticker symbol VUG, to really stack that up. And let's put a regular mutual fund. That's the Wilshire 5000 mutual fund. Let's go ahead and put EFA in here. Here's the emerging markets. Trying to think of one more ETF that could, anybody have an ETF off the top of your head? Here's total stock market to compare side by side with the Vanguard. Let's just hit submit. So here's $100 worth invested into each of these, including the I option. And you can see, you know, one of the reasons we were talking about, it'd be kind of nice to see some of those emerging market companies as an option. That's why you're hearing about them so much in the press. These two are the same investment. Vanguard Total Stock Market, they're both the Wilshire 5000. The big difference between the two is the expense ratio. So then you can see that's why we would like VTI in most cases, even for long-term investors, not just trading. And here's VUG. And again, what are you investing in when you invest in VUG? VUG, Vanguard Growth, the actual companies. Again, very much like the S&P 500, only to my way of thinking, some of the lower growth companies have been filtered out, and you see, wow, Facebook's in here now. Just kind of a higher growth component. And that bare naked million is really kind of a neat portfolio to look at for demonstration purposes. And I'm going to stick around here for a few minutes, but I hope you found this entertaining. I'm going to go ahead and stop the recording and educational, and thank you for coming out. Let us know what else we can do.